For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
You have suffered financial loss while investing, and you think your bank, broker, fund management company, unit trust management company, PRS provider or distributor, or their agent or representative is responsible. You need help sorting out the problem or want to seek redress. Where do you go? Sidrek is here to help you start the conversation and reach some resolution. First, lodge a formal complaint with a company that sold or offered you the unit trusts, shares, derivatives, or other capital market product or service. But you're not happy with their response. You have 180 days from their final written reply to come to Sidrek. Or if there's no written response, and it's been 90 days since you wrote to them, you don't need to wait longer. You may come to Sidrek even though you haven't received a final response yet. Sidrek first checks the eligibility of your claim. For example, is it within Sidrek's claim limit? Is it against a member of Sidrek? And so forth. If your case is eligible, we begin the dispute resolution process. All information in this process is confidential. We get both you and the member you're complaining against to sit with us and have a conversation. Documents and information will be required from both parties. No lawyers are allowed in the mediation process, as we keep the discussions informal and private. Our mediators are impartial and will hear both sides out and help parties communicate constructively towards resolving the dispute. 2 outcomes are possible at this stage. Either both you and the member agree to a settlement, or you don't. If the both of you agree to a settlement, an agreement is signed and the mediation process ends successfully. But if both you and the member fail to reach a satisfactory resolution, mediation has thus failed. But don't worry, Sidrek then proceeds to the next stage, adjudication. During adjudication, parties are given the chance to provide any further information to help their case and ask each other further questions. Our adjudicator will then study and consider all facts and information provided, including the conduct of the parties, laws, and best industry practices, as well as what's fair and reasonable. Sidrek's adjudicator will then make a final decision on the dispute and the monetary claim. If the decision is in your favor, it could be a full award or a partial award for your claim. But if the decision isn't in your favor, then no award will be made. You, the investor, will still have a choice. If you reject the decision, Sidrek will simply close the case and you may seek other legal avenues for redress. If you choose to accept the decision, however, the member has to comply with it. Once the parties have confirmed compliance to the decision, Sidrek will close the case. So let Sidrek help start the conversation towards resolution. For more information, visit sidrek.com.my or call 03 2282 2280.
Bursa Malaysia has been part of the Malaysian economic growth for over 4 decades. We have been working relentlessly to create a transparent, efficient, and vibrant stock exchange.
While we've been working at building a vibrant marketplace, inclusivity and contributing towards economic growth, we have also channeled efforts and resources towards supporting the community at large. Shares to Share is one such effort, which has been developed to create positive impact towards society and the environment. To put it simply, Shares to Share is a transparent and easily accessible facility that enables investors to donate their listed securities or proceeds from the sale of their listed securities towards charity through Yayasan Bursa Malaysia. You can donate odd lots or even board lots. The funds from the sale of these shares will be channeled to approved charitable organisations and their respective initiatives or projects.
Bursa Malaysia has waived its portion of the transfer fee, clearing and trading fees for all transactions that are conducted under Shares to Share. The participating brokers of Shares to Share have also agreed to waive their portion of the transfer fee and brokerage. The charitable organizations that have been selected have undergone the necessary due diligence process and have been duly approved by an independent selection committee.
At least 500,000 populations live with some kind of disabilities. They are most of the time being left behind. We need to empower them, otherwise they will continue to be the liability. A lot of human resources wasted from this group of people.
We provide a lot of support for persons with disability who are young adults and adults. We have a social enterprise called Project I'm Possible, where we manage to hire all persons with learning disability to work here. We have a cafe, bakery, weaving, and we have an art gallery.
Purity of thought, word, and deed, that is action, is very important to be really successful. We must know some skills to be able to help us then paperwork. The grant from Shares to Share will be used for, one is sewing, handicraft, classical dance, and so on.
Our patients have to be fed, they have to be looked after. We look out for any sort of disease they might develop, and also those unforeseen circumstances. Thanks to Bursa's initiative, we can be a little bit easy on our patients and their family members.
Donations will all be channeled to organizations that are involved in the sustainable development of Malaysia. The Shares to Share scheme offers you the chance to do so in a simple and effective way.
Bursa's Shares to Share allows us to do good by donating our shares to charities. Join us in making a difference to the society by donating your listed shares.
Shares to Share is open to all donors, individual as well as corporates or other types of entities. You can transfer your listed securities via Bursa Anywhere app at a click. For more information, please visit our Bursa Malaysia website.
Hello everybody. Welcome to Bursa Malaysia's webinar that is titled The Art of Portfolio Management. And this webinar is brought to you by Bursa Malaysia, managed by our company, LifeChamp. Now, the title today is The Art of Portfolio Management. As you know, portfolio management is an essential skill that every investor must learn so that we know how to reduce the risk and learn how do we build sustainable wealth in the stock market. So today, we're going to delve deeper into how do we build a solid portfolio. All right. So before we begin, as usual, disclaimer, whatever is shared in this webinar is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risks. Now, allow me to briefly introduce our speaker today. She began her career at RHB Investment Bank. She has spent more than 9 years in the financial services industry while obtaining a dual license, which is specializing mainly in the listed derivative and equities market. With over 6 years of experience and not less than 80 training sessions conducted, she has done an audience count of reaching more than 500 people. She regularly attends AGMs and company visits for different listed companies to keep her clients informed about the latest update during her sharing sessions. And she graduated with a bachelor's degree in banking and finance from Sheffield Hallam University. She's none other than Miss Tang Wai Yin. Hello, Wai Yin. How are you today?
Oh, hi. Can you just hear my voice?
Yes, we can hear you.
Okay, so I need to share my screen, right?
Yes, that's right.
Can you just see the screen now?
Yes, we can see your screen. Once you go full presentation mode, that'll be very helpful. All right, perfect.
Okay, is that okay?
Yes.
Okay. Hi, good evening, everyone. Hi, my name is Wai Yin. Thanks for joining me on today's session. I would like to have a brief introduction on myself before I start today's session. So for those who joined me before, please pardon me. I have nearly 10 years experience in the industry. Unfortunately, the market never goes up. I joined during, which is the red color box over here, the cursor. And working with my clients in the stock and futures market has helped me to quickly accelerate my learning curve in investing and trading. At the same time, attending AGM and corporate visit let me stay up to date with the company's operation, their financial performance, and also on their future plans. This exposure helps me give me the opportunity to network with other investors, analysts, and company representatives as well. After our company visits, right, we usually post writes up on our Facebook and Instagram pages, and recently we have our WordPress page as well. If you are interested, please feel free to check out our social media pages. Okay? And before I go into the topic of today, if you all have any question, you all can type in the chat box. My group member will help to answer on your questions, okay? Okay. The topic today is the art of portfolio management. I believe most of you are familiar with the traditional 60-40 asset allocation portfolio approach or the Ray Dalio all-weather portfolio. The traditional 60-40 portfolio involves investing 60% of our fund in the stock market, while the remaining 40% in the bond market. This allocation is then rebalanced every year to maintain the desired ratio. The 60-40 portfolio combines the growth potential of stocks with the stability of bonds, which tend to be less volatile than 100% invested in a stock portfolio, but it also offers lower return. Unfortunately, during last year, which is year 2022, both stocks and bonds dropped in value, resulting in the traditional 60-40 portfolio losing nearly 17%, compared to the S&P market drop 18%. Why the portfolio dropped so much is because the Federal Reserve raised interest rate after decades of keeping them low and relatively stable. And this performance marked the worst since the year 2008 financial crisis. In hindsight, investing in a 40% of our portfolio when the yield is less than 1% may not be the best idea for us. Therefore, we believe that having a dynamic asset allocation approach, which can adapt to the market changes and seize opportunities as they arise, may be a better alternative compared to the traditional 60-40 asset allocation strategies that involve setting fixed allocation for different asset classes and maintaining them from time to time. Okay, now, so before I go into the detail, let's do a quick test. Okay, now, let's assume we are somewhere in history with 100,000 capital to invest for the next 10 years. And we are not allowed to do any trades in between these 10 years. We have two portfolios to choose from, which is option A, a portfolio 100% invested in the US stock market, and option B, which consists of 25% investment in 4 different asset classes, which is US stock market, emerging market, long-term treasury, and gold. Okay, now, based on the information I am about to provide you, you can decide whether you want to choose option A or option B. Okay, first information. This is the chart that divides the MSCI Emerging Market Index by the MSCI World Index. When the ratio rise, emerging market outperform developed market. When it falls, developed market outperform emerging market. In this scenario, we are at the peak over here. This is the first information. Okay, now second information. S&P 500 during that time, their forward earnings yield is 4%, and the 10-year treasury yield is 6.5%. This is the second information. And the third information is S&P 500 to gold ratio. This chart tracks the ratio of the S&P 500 market index to the price of gold. The number tells you how many ounces of gold it would take to buy the S&P. So with these 3 information given, which option will you choose? Option A or option B? You all can type your answer in the chat box. Okay. I think most of you choose B. Okay, now we move on to the second scenario. It's the same chart. This time, the year we are currently at, which is the bottom over here, when the developed market outperformed the emerging market. This is the first information on the second scenario. And the second information is S&P 500 forward earnings yield is at 7.5%. And the 10-year treasury yield is at 3.8%. Okay, and the third information, S&P 500 to gold ratio is currently ranging around 1 ounces here. Okay, so with the second scenario, which option will you choose? Most of the people choose A on second scenario. Okay, now, this is the answer. Ta-da! In scenario 1, we are in the beginning of the year 2000, which we encountered the dot-com bubble during that time. And unfortunately, the S&P market experienced a lost decade afterwards. Option A, which was a 100% portfolio invested in the US stock market, didn't perform well over the next decade until year 2009. However, option B managed to grow at a remarkable rate of more than 8% per year, turning the initial 100,000 capital into an impressive 231,000 by the end of the period. Whereas in scenario 2, the starting date was from year 2010 2010, following the S&P lost decade. Interestingly, this time, option A outperformed option B over the 10-year period. Okay, so you know just now what you choose is correct or wrong already, and the result is here. And okay, now over the past 100 years, the stock market has averaged 9% return per year. However, it's essential to understand that this does not mean that the market implies a consistent 9% annual increase. In reality, there have been periods when the stock market generates no return for the entire decade. Okay. Although passive investment has become increasingly popular, thanks to the famous investors like Warren Buffett and Jack Bogle, there are times such as during the lost decade when the stock market underperformed. Investors may feel frustrated, lost faith, become tense. All this will cause the investors to abandon their strategies. During hard time like this, having a diversified portfolio with uncorrelated assets can definitely help smooth our investing journey. That's why this is the topic we are in today. Okay. With a long history of wealth creation, historical data has shown that stocks have outperforming other asset classes over the past 200 years, which is the blue color line over here, by taking a 20-year rolling approach. Even the worst 20-year period, which is over here, the market still delivered a real return of 2.35% per year during 1960 to 1979. And the best 20-year period has a stunning return, which is over here, stunning return of 13.35% per year, which is during 1980 to 1999. And with as little patience and the right strategy for compounding to work its magic, we could one day be living off the dividend from our portfolio. Okay, stocks always crash. Compared to other investment classes, all of us know that stocks are famous for their volatility. They can soar to a new heights in the short term, but they can also take a nosedive just as quickly. And here's the thing, stock market crashes and we have bear markets, we have corrections, and they are just part of the game. In fact, the market has seen 26 bear markets since 1928. That's when the stock market drops 20% from its peak. And then what about a correction? It's when the value of stocks has dropped at least 10%. And you know what? It happens 50% of the time. And during a typical bear market, stocks lose an average of 36% of their value. And it takes approximately 9.6 months or 289 days for the market to recover. In fact, over the last 5 years, there have been 3 bear markets. To be honest, stock market downturns, corrections, and panics can be painful and difficult for us to endure. And then predicting the next bear market is impossible. But don't be discouraged. History shows us that even after major events like World War, recession, market will eventually recover. The most amazing thing is, even though the market has experienced crashes, recession, and correction, stocks have been qualified as the best performing asset classes and a great way for individuals to build wealth over the long term. Okay, this is the S&P chart by decade. On average, the market has delivered a return of 175% per decade, while the average yearly return has been around 9%. Remarkably, during the challenging decades of the 1930, 1970, and year 2000, certain other asset classes outperformed the S&P, which is this emerging market, treasury, and gold, providing valuable opportunities to the investors. After a period of great success in the US stock market, challenging decade tend to follow. Therefore, when the market is expensive or experiences a super bull run, maintaining a diversified portfolio become important to us, even if we happen to be wrong, as seen in the scenario 2 for option B just now. A well-diversified portfolio can still yield a decent return. Unfortunately, obtaining historical data on the Malaysia stock market is challenging, and I was only able to access data since 1970 from Credit Suisse latest investment return yearbook. After adjusting for inflation, the average annual return for the Malaysian stock market is at 6.3%. Okay. As always, we believe that we can grow our wealth one investment at a time by following these 3 key principles, which is focus on high quality businesses, invest regularly, and build a diversified portfolio. We believe that over time, business performance, which is earning growth and dividend, drives the share price. On the chart over here, the yellow and the orange area represents the earning growth and dividend, while the pink area, the small pink area over here, illustrate the change in valuation. However, it is important to understand that in the short run, business performance and investors' sentiment may not always align. Within each individual year, even a good business with good fundamentals, it can be overshadowed by contrasting market sentiment. The longer the investment horizon, the more likely that the business performance will drive the stock's return rather than the market-driven changes. As a result, we actively seek out businesses with potential for sustained revenue and earnings growth over the long term. We look for exceptional businesses worldwide that share these characteristics, which is scalability, growing industry, market leader, sustainable competitive advantage, strong management, solid financial position, strong cash flow, and lastly, high return on capital. Okay. Now, we are in the MSCI World Quality Index, which is the blue color line over here. According to MSCI, the quality factor aims to reflect the performance of companies with durable business model and sustainable competitive advantages. MSCI achieved this by targeting companies that tend to have high ROE, stable earnings, strong balance sheet with low gearings. Institutional investors will consider quality for additional sources of return or for diversification purpose. And then quality has also traditionally served as a defensive factor when a fight to quality occurs. Okay. Now, this is the MSCI China ETF. Despite China being the second largest economy with impressive GDP growth over the past decade, but the performance of the China stock market has not been favorable to investors during the same period. And during the same period, suppose we invested in Tencent, a company that has seen its earning growth at an impressive rate of 30% per year, which is over here. You can see EPS here, yearly CAGR 30%. Despite a significant value drop of 67%, or more than a 10% annual decrease, which is here from 40 something drop to 15 times now, the stock price still managed to achieve a return of 18% per year, which is over here, share price. This highlights the importance of Focusing on the business fundamental, even if our valuation assumption were wrong, a long-term investment in a company like Tencent that can compound its earnings can still generate decent return. Okay, next. Following the subprime crisis in year 2008, US implemented QE, which is quantitative easing, and cut interest rates to stimulate the economic growth. During this time, despite MACD growing its earnings at an average rate of 5% per year, which is here, CAGR 5%, the stock's valuation doubled, which is from 17 to over 30 over here. As a result, the share price was able to compound at a remarkable rate of over 10% per year, which is over here. This serves as an example. Even with relatively moderate earnings growth, it shows how favorable market condition and valuation adjustment can significantly impact a stock's performance. Whether MACD valuation will continue to increase over the next decade, well, only time will know. Now, Apple. Investing in stocks like Apple, where both earnings growth and valuation expansions occur simultaneously. It is the best scenario to us. During this period, Apple's stock price went up 28% per year, which is over here. Even if there were no changes in its valuation, Apple stock price could still potentially grow at 16% per year, which means if this is unchanged, we still have a 16% growth per year over here, solely driven by its earnings growth. Now, imagine we are somewhere in history between 1920 to 1979 and get to invest in the stock market for the next 40 years. And we are not allowed to make any trades in between. Would you rather choose option 1, DCA, which is dollar cost averaging? In this case, I will use DCA. Invest $100 every month for all 40 years, or buy the dip, which is BTD, save $100 each month and wait for a market correction. In this scenario, we will know exactly when the market is at bottom between any two all-time high. Okay. According to these studies, DCA beats BTD over 70% of the time. BTD missing the bottom by just 2 months lead to underperforming DCA 97% of the time. BTD outperformed DCA when big correction happened earlier in the time period, which is during 1928 to 1957. Generally, BTD underperform market most of the time. The reason why BTD underperform is corrections, especially the larger ones, are rare. Without the dips to buy, we will be sitting on cash, which is not a good way to grow our wealth. Right? Okay. Now, in order to build a diversified portfolio, how many stocks should be included in our portfolio to achieve effective diversification? Studies indicate that investors should have 20 different stocks in their portfolio. Investing in 20 glove stocks or bank stocks is not diversification, yeah? And this investment should be diversified based on geographical location, industry, and risk profile of each company. The marginal effect decreases after owning 10 to 15 different stocks. On top of that, we control our risk by excluding riskier stocks and industries from the beginning. We invest only in company with solid financial position and put together a group of high quality businesses from different industries. A well-diversified portfolio reduces our exposure to a single stock, single industry, or country, making our portfolio more adaptable to unexpected events. While a fully invested portfolio, which is the blue color line here, 100% fully invested portfolio, tends to generate better return than a 60-40 traditional portfolio approach, the red color line over here. It is also more vulnerable to drawdowns and losses. You see, the red color line drop lesser than the blue color line. Blue color line is the fully invested portfolio. Holding a large percentage of the portfolio in bonds during period of low interest rate or significant stock market drawdown may not be a good idea or strategy to us. Therefore, we believe that a dynamic asset allocation strategy should take in valuation, timing, and market condition into consideration. Having an allocation model that allows us to increase equity exposure when the market conditions are favorable to us could be a better strategy. Our ultimate goal is to have our entire portfolio invested in stocks. However, we understand that not every time is the ideal time for us to start with a fully invested portfolio, stock portfolio. Once we have decided on our desired allocation to stocks, the remaining portion of the portfolio should be diversified with assets that have low or no correlation to the stocks market. Example of uncorrelated assets include cash, treasury, corporate bonds, gold, commodity, emerging market versus developed market equity, and last one, real estate. Although these assets are not correlated, there are some times when they may move in the same direction under specific market conditions. For example, during year 2022, which is last year, both stocks and bonds dropped, and in year 2008, emerging and developed market, along with the commodities and real estates, experienced a simultaneous decline. Now, first one, cash. We certainly know that this is an uncorrelated asset, while for treasuries, also known as government bond, and the stock market typically exhibit low correlations. They are considered as a safe haven asset as the probability of default by the US government is very low, making investors actively seek out treasuries bond during market uncertainty or economic instability. For example, during crisis period like year 2020, 2008, and year 2000, as well as older days in the 1930, 1970, and 2000s decade, treasury bonds generate better return than stocks. Therefore, including treasuries in our portfolio when the yield is reasonable can be a strategic move to enhance diversification and manage risk. At the same time, it providing us with a valuable assets that perform differently from the stock market under various economic conditions. Okay. Investors commonly perceive gold as a safe haven during periods of market instability. During times of crisis, gold tends to outperform the stock market, making it an attractive hedge against potential losses in a portfolio. Interestingly, gold 12 months correlation with the S&P 500 market over the past 45 years averages around 0, indicating its diversification potential. while the year 2010, which is 2010, proved to be a challenging decade for emerging markets, including Malaysia, experiencing their worst performance since the 1930s with a return of 49% compared to the impressive 255% of the S&P 500 market. But investment in emerging markets come with risks, including political and economic instability, regulatory risks, poor corporate governance, liquidity risks, social and environmental risks. Since earnings growth fuels share price appreciation over time, a key factor behind why the emerging market underperformance is because the uninspiring earnings growth in emerging market over the past decade. However, when we look at the data in the past 100 years, emerging markets have had their moments of outperformance, notably in the 1930, 1970, and year 2000 when the S&P 500 market struggled. We come to minimum allocation. The minimum allocation in stocks depends on various factors, including an individual risk tolerance, investment goal, time horizon, and current market conditions. Generally, investors should have at least a small allocation to stocks, even if they have a conservative risk appetite. A common rule of thumb is the 100 minus age rule, where an investors subtract their age from 100 to determine the percentage of their portfolio that should be allocated to stocks. For example, a 30-year-old investors would allocate around 70% of their portfolio to stocks, which is we use 100 minus 30-year-old, while a 60-year-old investors would allocate around 40% to stocks. Now, let's take the EPF as an example. Despite EPF being a conservative pension fund, the EPF allocates more than 40% of its portfolio to the stock market. Therefore, we believe that a minimum allocation of 40% in stocks can be suitable starting point for conservative investors. Okay, so far so good. Now we are going into price versus fair value. As investors, we want to purchase a stock when it's trading below its intrinsic value, right? However, the biggest investing regret for many of us is missing out on a great stocks because we thought it was overvalued. Take Nvidia, for example, a true shining star this year. With a fair value estimate from Morningstar analysts, according to the estimate, Nvidia was considered overvalued more than 90% of the time. The red color is the fair value, the black color is the price. Imagine if we miss out on a stock like Nvidia that has surged more than 10 times because it was overvalued, can be disheartening. Even during its year 2022 market bottom, even we buy at here, the bottom here, Nvidia was still 50% more expensive than its peak, which is here in year 2018. But at least we still have a chance to invest in this share in year 2022, which is last year, if we follow this valuation model. Then what about stocks like Hermes, which often perceived as overvalued? I believe many of us has experienced missing out on great stocks because they are overvalued, while the one we invested in, hoping it as an undervalued gems, didn't perform as well as expected. For example, like Alibaba. From these examples, we understand that the concept of minimum allocation become crucial in this kind of situation. When we come across a truly exceptional business that appears expensive, we can still allocate a minimum portion of our portfolio to the stocks. By doing so, we ensure that we don't miss out on investing in a great company like Hermes and Nvidia. Okay, given that Morningstar doesn't cover Malaysia stocks, we simply use a 15x PE ratio to estimate the fair value of these stocks in this scenario. You probably heard someone or some people preaching the golden rule of PE must be below 10 times lah. Okay, which in this case, we indicate that 15 times PE is considered to be expensive. This example shows that stocks with good earnings growth may appear expensive, which is like Vitrox and Inari, while the so-called value stocks are often priced below or priced lower for specific reason, which is like Sebah, CIMB, Astro, OSK. From all these examples given, what we want to emphasize is that regardless of whether the valuation is expensive or cheap, we still aim to maintain a certain exposure in those selective shares. We may not be able to predict whether the expensive stock will become even more expensive in the future, but we can mitigate our risk through better allocation method, ensuring that we don't miss the opportunity to own a stake in the quality businesses within our portfolio. Now, in this scenario, we can adopt a dynamic allocation strategy, which is from the slides here, allocating 40% when a stock appears to be expensive, 60% when it seems reasonably priced, 80% when it's undervalued, and going all in 100% when it is exceptionally cheap. For those who prefer a balanced approach and don't want to go all in on Alibaba or just minimally allocate to Hermes and Nvidia, the equal allocation over here can be the strategy or the best way for you to go. This approach involves dividing the investment capital equally among these stocks. So now, let's take a look at this table. And assuming you are holding 100% cash now, and you don't know how much to allocate for each shares. So for stock A and stock B, which is considered to be expensive, based on the valuation model just now, we would be allocating 40% on these stocks, which is 8,000 each for stock A and stock B. While for stock B and stock C, which is considered cheap, we will allocate 80%, which is 16,000 each on stock B and stock C. Last one, which is stock E, considered to be reasonable, we will allocate 60%, which is 12,000 on this share, and we will end up invested 60,000 of our money in this portfolio, and therefore we are 60% invested our fund in this portfolio now, 60%. Okay. And for the investors who prefer equal allocation, now take a look at this real case study, which we use a simpler method to determine equity allocation based on valuation. This helps us avoid an overexposure to slow growth stock that may appear cheap, like Maybank, and ensure that a balanced allocation to high growth stock that tend to be expensive, which is like Vitrox. Every year, we select the top 10 quality stocks from different industries. These are the companies that most of us are familiar with. Unfortunately, we don't apply the same strategy for Malaysian stock because there are limited numbers of industry experiencing a circular growth. And this list, we have Apple, Microsoft, Google, Visa, LV, Moutai, L'Oreal, Alibaba, MACD, and S&P Global. And this is the stock list we sent out at beginning of this year. And we have almost the similar, but we replaced the Alibaba with NVIDIA. This is because NVIDIA, Alibaba ROE is declining. That's why we replace it with the NVIDIA. Okay. Now, basically, our strategy is very straightforward. If a company forward PE is below its 5-year average PE, we consider the valuation reasonable. The minimum allocation for this approach is 50%. So, when 7 out of 10 stocks are trading below their 5-year average PE, we allocate 70% of our portfolio to these stocks equally. If only 3 out of 10 stocks meet this criteria, we allocate 50% of our portfolio, which is the minimum allocation for this approach. With this approach, we can increase our equity exposure when more stocks have reasonable valuation. Okay? Throughout the years, there were 7 stocks trading below their 5-year PE, average PE, at the end of year 2017, 10 in year 2018, 6 in year 2019, 4 in year 2020, 5 in year 2021, and 10 in year 2022 after the bear market. Therefore, if we started our portfolio in the beginning of year 2018, we would allocate 70% of our portfolio into these stocks equally, which is these stocks equally. Okay. If we start our portfolio in the beginning of year 2022, we would allocate only 50% of our portfolio into these stocks. Now, with the right strategy, a fully invested portfolio always outperform, which is here, 100% invested here, the column over here. However, by only allocating 50% of our portfolio in year 2022, which is over here, we experience a significant lower drawdown compared to the fully invested portfolio and overall market. Okay, now, next. For investors who fully rely on technical indicator to identify good entry points to increase the allocation in the stock market when it is oversold could be a strategy. Indicator like stochastic or RSI are popular technical indicator for generating overbought and oversold signals. Traditionally, for stochastic reading over 80 are considered in the overbought range, and reading under 20 are considered oversold. For RSI, reading over 70 are considered in the overbought range, and reading under 30 are considered oversold, which is in this chart, we indicated that overbought and oversold. In this scenario, using oversold and overbought indicator to time the market seems like a perfect strategy. Unfortunately, when the market is in a strong trend, this indicator may stay in the overbought or oversold region for a long period of time, which is here, you see here. I recall a specific example when our founder sold these stocks when it was overbought. He can only witness this share surge by a few 100% within a few months. Okay, now theoretically, in a sideways market, the signals generated by the oversold and overbought indicator are highly accurate. However, as the market trends upward, the reliability of the overbought signal reduces, and when the market trends downward, the oversold signal becomes less reliable. Given the market's tendency to rise in the long run, means market up in the long run, we believe that focusing on the oversold signal while ignoring the overbought signal could generate better results. By using this approach, we aim to capture the potential buying opportunity during bear market or market correction. Taking the monthly chart, for example, which is this, over the past 100 years, there were only 6 instances of oversold signal for the RSI, which is during year 2008, which is here, year 2000, 1974, which is here, 1942, 1938, and 1932. This approach successfully timed the market bottom on all 6 occasions, making it a highly promising method for us to enhance our portfolio return. The KLCI index monthly chart show oversold condition in year 2020, year 2008, and definitely on the 1997, presenting excellent entry point for investors to increase their equity exposure. Now, zooming into a weekly chart, in this scenario, the FBM Small Cap Index provides more frequent oversold opportunity compared to the monthly chart just now. While the probability of precisely timing the bottom might be lower with this approach, it offers us more chances to identify potential entry points. Furthermore, if we mistakenly invested during the wrong market bottom, such as the one in April 2018, which is the blue color arrow over here, even though the overall market has only experienced slight growth since then, which is the small rebound, the swing over here, selecting the right individual stock could still lead to significant return. Like Vitrox, during the same period of time, they generated more than 200% return, and like Apex Healthcare, it has more than 150% return. On the other hand, if we made a stock purchase during market bottom in March 2020, during the COVID pandemic, which is the blue color arrow over here, but chose the wrong stock, despite the market trading higher, it could still result in negative return, which is like this. This emphasizes the crucial role of stock picking. It is important to note that the markets spend most of their time outside the oversold region, waiting solely for oversold signals to happen on the monthly chart since the 80s would have resulting in the significant opportunity cost. This highlights the importance of having a minimum allocation strategy in place by maintaining a basic level of exposure to equities. We can capitalize on potential opportunity so that we don't miss out on the long-term growth potential of the market. If you prefer not to study company valuation or analyze chart, this minimum allocation plus drawdown model might be the perfect strategy for you. The concept is to seize opportunity during market downturn by increasing our stock market exposure. Let's say if our desired minimum allocation for stock is 50%, when the stock market experiences a 10% drawdown, we can increase our equity allocation in our portfolio to 60%. In the event of a 20% drawdown, our equity exposure can increase to 70%. Understand? During significant financial crisis with drawdowns exceeding 50%, like those in year 2000 and year 2008, our portfolio would be fully invested in stocks. This flexible strategy allowed us to take advantage of market opportunity compared to the traditional 60-40 portfolio approach. Okay? Now, let's take a look at a real case study. Unfortunately, in the beginning of year 2022, which is last year, right before the start of a bear market, one of our clients gave us a lump sum to invest. Starting this portfolio at an unfortunate time, with markets trading near their peaks, certainly presenting a daunting challenge, which is the red color arrow over here. This is the time when our client gives us the lump sum of money. We have to take the challenges from geopolitical tension fueled by Russia-Ukraine war to rising global inflation, higher energy and raw material prices, rapid interest rate hikes, banking crisis, US debt ceiling risk, and the impending recession risk. There has been no shortage of negative news during last year. Given these circumstances, you all might assume that the portfolio would have suffered a substantial drawdown by now. The maximum drawdown of this portfolio reached 18% in October 2022, which is last year over here. But since then, it has recovered and now has a return of more than 15% since its inception. After understanding the client's risk profile, we only invested 50% of the portfolio in high-quality businesses. As the market continued to decline, we increased our investment to more than 70% of the portfolio. Despite the market not fully recovering, our portfolio still managed to achieve a return of over 15%. This better performance was partly due to stock picking and the focus on risk management, which limited our portfolio drawdown to 18%, while the market dropped nearly 30% last year. During the same period, some hot stocks or funds like Katie Wood Ark Fund dropped more than 70%. I believe you all know who is Katie Wood. Now, if we had invested all our money at the beginning since the inception, the return today would definitely be higher. But the portfolio could have suffered a decline which is more than 30%, leading to potential panic or withdrawal from the client. Therefore, our commitment to risk management play a crucial role in getting through uncertain market conditions. While external factors may create market volatility and uncertainty as well, thus, having a well-constructed portfolio with high-quality businesses has the potential to not only weather the storm, but may also lead to favorable outcomes that outperform market averages as well as other investment funds over the long run. Now, here is the latest emerging versus developed market ratio. Currently standing at 0.34, which is here. The US, with its significant 70% weightage in the MSCI World Index, has been performing remarkably well since year 2009. While the MSCI emerging market have been underperforming during the same period. This is the latest treasury yield, on the other hand, has risen following the rapid rate hike by the Federal Reserve. The period of low interest rate environment since 2009 has contributed to the stock market strong performance here and the expansion of valuation. For example, stock like MACD and Apple in the example just now. Finally, an interesting observation is that during market bubbles and before the recession, the S&P to gold ratio tends to surpass its previous peak, which is here, dot-com bubble here. The ratio is higher than the previous one. So the next time when this ratio reaches a new high, it could be a sign that we could be careful with our investment approach. So currently the ratio is at here, still a far way to go, but we need to observe on this. Okay, now, so this is the last slides of my presentation today, and I will end my presentation over here. Thank you, everyone.
All right, thank you so much, Wai Ying, for sharing with us the art of portfolio management. So if you have any question to ask our speaker today, you may write them in the Q&A box, okay? So write them in the Q&A box so we can address your question accordingly. All right? Yep, so write your question in the Q&A box here. So Wai Ying, how do we buy Malaysian government securities?
You can buy from bank, through bank.
All right. Is there any minimum criteria?
I don't think so.
All right. So I think that would have answered the question. How do we know if this is a quality stocks besides assessing the return on equities?
Yeah, one moment. Quality stocks beside ROE.
Yep.
Stability with their financial health, health and growth.
For example,
few criteria. Like just now, we have the characteristics slides over here. Let me come back to you. This one, high quality business. This is the criteria.
All right.
Yeah, and with a few years of high ROE, which means they maintain their ROE at the high side for a few years, continuously for a few years.
Okay. Thank you so much, Wai Ying. Hope that answered the question by Jia Bei. Please write your question in the Q&A box. Don't write that in the chat box. Okay, write them in the Q&A box. The next question by Kok Wing is, to fulfill the allocation, do you have any recommendation for any ETF?
Recommendation for any ETF? What kind of ETF you are looking at? Because there are many ETF available. Malaysia, we normally...
I think the clarifying statement is that to fulfill the stock, bond, and gold allocation. I think on Bursa Malaysia, we have a handful of ETF. We have a gold ETF that are listed on Bursa Malaysia that's issued by Trade Plus. We also have a bond ETF that's listed on Bursa Malaysia. And we have quite a number of stock ETF. Yep, that you can consider they are listed on Bursa Malaysia. So on Bursa Malaysia, our selection of ETF will give you exposure not only to the Malaysian equity markets, but also give you exposure to the bond market, commodity market like gold, and also the foreign stock market. Okay, it can give you exposure to American stocks and also give you exposure to the Chinese stocks.
Yeah,
Alright,
for
so-
the Kok Wing Lam, right? To fulfill the stocks, bond, and gold, you can get gold as GLD ETF, and the TLT for the emerging market, which is a long-term treasury, is TLT, and emerging market you can get EEM, the ETF. What platform?
So the next question by Edmund is, what platform do you use to do valuation of Malaysian companies?
Normally we will use Bursa Marketplace, which is available by Bursa. Yeah.
How do you use Bursa Marketplace to know the valuation?
They have the calculation and the research report over there. One moment. Oh. You can come to the analyst consensus.
Are you showing us the screen?
Yeah, one more. Oh, sorry. Yeah.
Yeah, I'm not seeing your screen yet.
Okay. Sorry. Share screen, please. Yeah, you can come to Bursa Anywhere, and then you just search the company you want, which is this. In this case, I will take Witros, and then you go all the way down to research, and then you can click on this, the first report, then you download. They have all the information available over here. One moment.
So this is available on Bursa Marketplace.
Yes, correct. Which is here. Can see? Yeah, all the complete information will be here. From the 5-year return, 1-year return, and then here you have the earnings fundamental, all the rating score will be here. And the competitor as well, their peer analysis over here. There's around 10 pages, so you can read out from here.
Do you know who produced this report?
I don't know, maybe from Bursa. Because it's posted from at the Bursa. The Refinitiv, which is here, there. Data Refinitiv. Yeah. Yeah, that's the page we use for the Malaysian stock.
All right. So the next question by Kelvin is that, are there any free resources where we can see the trend of sectors' performance?
One moment. We use RHB TradeSmart chart to look at the historical chart for each sector. So basically, I believe most of the platform do offer this as well, right? For Malaysian stocks, you can click on each sector chart to read on the chart.
All right. So Ayman asked, do you have any good books that you can recommend that we can read on this portfolio topic?
Which is the Pioneering Portfolio Management by David Swenson.
Okay.
Yeah.
So you like the book?
Okay lah. You all can read through if you all wanted to have a better understanding on the portfolio management things. Yeah.
All right. Thanks so much, Wai. So any other questions? Please write your question in the Q&A box here. We have another 15 minutes Maybe you can since while we're waiting for question, right? Maybe you can show us how do RHB TradeSmart, how do you look at RHB TradeSmart for the sectoral performance?
Yeah, one moment. Okay, this is the chat, the RHB TradeSmart page. You all can see, right? Can is my screen sharing on this?
See it. Yes, we
Yeah.
can see it.
Okay. So you can go to here and then you go to the sector and then you just click it, or you can directly go to the advanced charting. And then you just technology. So the whole technology index will be available. If you prefer for the property, so you choose property and the whole sector index will be available. Like that.
All right. I think Kevin said very helpful. Okay. So the next question by Kok Wing is that those exchange traded funds listed on Bursa Malaysia are too illiquid to buy and sell. Do you know any active one? So what do you think about this?
Then I think Bursa ETF need your support to make it become more active, because seldom there is not much people buying Malaysia ETF yet for now.
If I may add on to this question, Kok Wing, to buy ETF, right? There are always market makers. So liquidity should not be a big issue because there are always market makers who are making the market for the exchange traded funds. They are listed on Bursa Malaysia. Even though from the charts, you see that there's little volume, the volume may not meet your expectation. However, there are always liquidity in the market. There are always bid and ask, and there are lots that are queuing at the bid and ask, waiting to match your order. Okay, so even though it may seem that the volume is low, but liquidity is always there. Okay, so there are market makers who will always sell it to you and also buy it from you when you want to sell. So it is not to worry about liquidity lah. Okay, buying stocks is different because buying stock, the seller will queue at the market is based on the supply and demand. All right, but buying ETF or buying structured warrants, the product itself have market makers who will queue the bid and queue the ask for you at a fair price. All right, so you don't have to worry about the liquidity that much, unless you buy in huge volume. Then of course that may be a concern. Next question by William is that which of your portfolio strategy can be used to generate higher returns in the current Malaysian market?
I think still back to the same criteria, which is high quality businesses that I have mentioned just now. Yeah, and how and when to filter out the asset when it is not performing is when the specific counter or the stocks does not meet any of the criteria anymore. Where, for example, like when the ROE fall below the required level, then we will remove that, or when the debt is becoming too high in a sudden, or when the revenue is not growing.
All right. So when they don't meet your performance indicator, then you remove them lah.
Correct.
Okay. Hope that answers your question. Kelvin, next question is, notice that most ETF price is lower than the, and I think you mean NAV, right? Or NTA. Okay, it's written NTA, but I think he means NAV. But not much price movement. So am I right to say that there is opportunity cost by sitting with Malaysia ETF? So what do you think?
I'm not an expert in the Malaysia ETF. Shane, can you help me to answer this?
Well, the ETF price is not necessarily the same like the NAV, but if you buy mutual fund, then the price you buy and the price you will sell will likely be the NAV. Okay, most of the time it will be the NAV. But because ETF is listed on the exchange, so they always trade at premium or at discount to the NAV. So if you notice that the price is consistently lower than the NAV, it means that it is consistently traded at discount. So some people may see that you always buy this fund at a discounted price. So one day when the market realizes the true value, it may be trading at the NAV or slightly above the NAV. But if the price is lower than the NAV in a wide margin, chances are there will be some arbitraging that will make the ETF price come closer to the NAV. Okay, so the most important consideration when it comes to the ETF is whether you are buying the ETF that meets your investment objective or not. So if the ETF investment objective is to give you exposure to this sector, to this market, if it meets objective, then I think you can consider that lah. So that's the primary consideration, whether this ETF can help to complement your portfolio construct or not. So that is the main consideration. Okay, then of course the next is to observe and monitor the performance, see whether it meets your performance or not. Okay, do they mirror the index to as much as possible or not? Because sometimes the tracking error could be a bit big. So your job is to ensure that the ETF that you buy closely tracks the index as close as possible. If not, then maybe the portfolio managers are doing a lousy job, or maybe the ETF is constructed using a manner that is not full replication. Okay, so this is how the ETF is constructed. All right, so I think that would be a better consideration. Okay. Hope I answer Kelvin's question. Wong like to ask, does the portfolio be just Malaysian stock market only, or we need to add foreign stocks for better diversification? So what is your view, Wai?
I think this is on personal preference. So me, I would prefer to add in some foreign stock for better diversification. Yeah, so this is up to you whether you want to include foreign stocks in your portfolio or not.
All right. So I think leave it to you lah. Of course, if you have foreign stocks, then you may have the currency risk. Okay. Sometimes the currency risk will move in your favor. Sometimes the currency risk may move against you. So bear in mind of that. Saucy would like to ask, other than RHB TradeSmart, does CGS iTrade has this feature, sector trend?
I'm not familiar with the CGS platform. I think you can refer back this to your reminder or your dealer. Yeah.
All right, thank you, Wai Ying. The next question is, would buying ETF be a better portfolio management than just purchasing
I think you missed
several
out on the
individual
other
stocks?
one, which is from Edmund. Is it?
Okay, let's take one question first, okay? Do you see the question? Would buying ETF be a better portfolio management than just purchasing several individual stocks in the long run?
I think this is very personal as well. It's on your personal preference. Yeah.
my view is that if you have time to do stock picking, then of course you can do direct investing yourself. But if you've got no time to monitor the stock development, and read about the market, understand the market development, then buying an ETF, which is through passive investing or indirect investing, might be a better option, because you may not have the time to follow through with the stocks that you have bought. Then better pass your capital, your money to a experienced portfolio manager to get them manage it for you. That's my opinion.
Yeah,
Okay.
and in the US, right, a low-cost index fund can outperform like more than 90% of the investor. That's why it become quite popular or famous there. But personally, I think I prefer to pick stocks because beating the market is quite fun. Yeah, the satisfaction. Yeah.
Thank you, Wai Ying. So Edmund asked this question: why is FPM KLCI limited to 30 stocks? In the America, S&P 500 consists of 500 companies.
This is because the market cap has already covered a large percentage of the free float adjusted market cap in Malaysia of these 30 blue chips counter lah. So the market cap of these 30 stocks already, which is take up quite a big portion already. Yeah.
All right. So it appears that we have addressed all questions on our panel today. So thank you so much, Wai Ying.
Thank you.
Okay, let me go to my slide. So ladies and gentlemen, you just heard from Miss Tang Wai Ying, who is a dual licensed advisor with RHB Investment Bank. So thank you so much, Wai Ying.
Thank you.